Alright, for this video I wanted to do a walkthrough of the Schedule K-1 for a Form 1065. So we've got a sample K-1 package here which includes a couple of pages, and we've also got the Form 1040 for this partner, so we'll have a look at all the items that are on the K-1 and how those get transferred over to the appropriate place on his 1040. So the K-1 has page 1 here, and then we've also got a couple of pages of footnotes, so there's some supplemental information here. Page 2, page 3, some additional info as well. And the fourth page is information on QBI, so that's the qualified business income items that are passing through. And we do have a partner's basis worksheet, so we'll cover this as well. And then lastly, we have the Schedule K3 notification alerting the partners that K3 is not going to be provided because it qualifies for an exception. So we'll go through all these, and of course, again, we'll have a look at each item and how it gets moved over to the return. And then we've also got just one slide here covering some background on the fact pattern, so we get a sense of what we're working with here. So in our fact pattern here, we're going to have John Z, taxpayer. He's a Florida resident, and during the year he invested $115,000 into a private investment fund. Now this fund is trading in stocks, bonds, futures, has some treasuries and other alternative investments, and so we're going to see how all those items are separately stated on the K-1 and how they get reported on John's return. Now, really important here, John is just a limited partner, right? So he doesn't actively or materially participate in any of these operations. And that's important when we have a look at things like the passive activity loss rules, right? And so we'll see that being implemented here for him. Now, his other income, he's got wages of $178,000, and he is going to be itemizing his deductions. So we're going to have a Schedule A on his 1040, and we'll see how some of these items on the K-1 move over to that Schedule A. All right, so let's have a look at the K-1, and we'll start going through some of these line items. Okay, so first thing is some of the identifying information on the left-hand side. So we've got the name and address and EIN of the partnership, and then in Part 2, information on the partner. So we've got John's name, his tax ID number, and they have indicated here that he is a limited partner, right? So he's not an LLC member manager. He is a domestic partner, so he is a U.S. person. And the type of partner, he's an individual, and they've highlighted that it's a passive activity to him. Now, the partner share of profit and loss, often these are the same values, right? The amount of profit and loss and capital is going to be the same percentage, but not always the case, right? Because partnerships allow for things like special allocations, so you might have different profit and loss percentages over your capital accounts. In the Schedule K-1, if there is an allocation of liabilities, those would be reported here. In this case, the partnership doesn't have any debt, so they are reporting no liabilities at the end of the period. Item L, the reconciliation here. So this is a reconciliation of the partner's individual capital account. So we can see here capital contributed is the amount of cash or property contributed during the year. There's this $115,000. All of the income and expense items that we're going to see up here reconcile down to the current year net income or loss for the taxpayer. Withdrawals and distributions, so the amount of cash or property that was distributed out to the partner during the year. This is also a line item that's reported on 19A for cash distributions, and then his ending capital account. All right, so let's start looking at some of the income items here. So the line 1, ordinary business income or loss. Well, the partnership was invested in some other pass-through entities that generated this loss here, right? So John's allocation of the -$8 in ordinary business income or loss is reported on his 1040, right? But what's important here is how does it get reported? Remember, John does not actively participate in this business, so this is all a passive activity to John. Well, when we report partnership income or loss, normally it's going on Schedule E in Part 2. So Part 2 is where we report income or loss from partnerships and S-Corps. This is where we report the ordinary income or loss items. So we've got the first entry here, not real partnership, LLC. It is a partnership entity. But you notice here on row A for this partnership, the amount of loss that's being allowed is 0, right? We don't have a -8. And why is that? It's because it's a passive activity to John. So he does have to complete the form 8582. So this is where you would report any kind of losses from passive activities that cannot be used in the current period. So they have to be suspended and carried forward to the next year. So that's first reported down here in Part 5. So we can see we've got the Not Real Partnership LLC. For the current year, there's no net income. There's only a loss of $8. There's no prior year activity because this is the first year John's invested in the entity. So we have the -8 of net loss. And so the -8 of losses is reported up here. And so this is going to be the amount of losses that is suspended. So he completes the 8582 for that -8 figure. And then again on page 2 of Schedule E, we are not reporting any kind of passive losses because of the passive activity loss limitations. Now there's obviously other limitations that apply, right? Basis issues or at-risk issues. But in this case, he has plenty of basis. It's just the fact that it's a passive activity loss, which is why he can't record that. So moving on down here, this entity has some interest and dividend income. So the $508 of interest, that would just be reported on Schedule B. So if we have a look at John's return here, we go to Schedule B, we can see he's got an entry, Not Real Partnership LLC, and there's the $508 of interest income. Now, if we have a closer look at the line 5 item, there is a footnote that provides more detail on what comprises that interest amount. So we can see here line 5 interest income details. There's the $508 figure, but notice how it's been broken out into 3 categories. So we have bank deposit interest, interest from some corporate bonds, and U.S. Treasury interest. Now, this is important because all of this is taxable at the federal level, but U.S. Treasury interest is not subject to state taxation. So in John's case here, he is a Florida resident, so he's not doing a state tax return anyway. But if he were in a state, let's say New York or Georgia, he would have that $508 certainly taxable at the federal level, but he would have to adjust for the piece that is U.S. Treasury interest because that would not be subject to state taxation. So it's really important that when you look at these items, so the interest, dividends, all these other things, make sure that you're reviewing any footnotes to provide more information because you don't want to unnecessarily have all of this subject to, let's say, state income tax when it doesn't have to be. All right, so moving on to the dividends. So we can see total ordinary dividends of $19.45, and the portion of that that's qualified is $679. So similar to the interest, the dividends get reported on Schedule B. So we have the Schedule B dividend income. So the total ordinary dividends, $1,945. Now the qualified portion is separately stated in 2 places, right? So it's separately stated on page 1 of the 1040. On line 3A. So we have line 3A, there's the qualified portion of dividends, $679, and there's the total ordinary dividend amount. And he would also want to have the qualified dividend income reported on that qualified dividend income and long-term capital gain worksheet, right? And that's because qualified dividends are subject to a reduced tax rate. All right, so that's the dividend income. Now the royalties, so we have box 7, royalty income of $15. So royalties are generally just subject to ordinary income taxes, and they're reported on Schedule E in Part 1. So Part 1, normally this is done for rental real estate income, but if you do have royalty income, you would report it on Schedule E as well. So we see here line A, we have from K-1. We've indicated that it's a box 6 item, so 6 is for royalties, and the total royalties reported on line 4 of $15. All right. Now, after the royalties, we've got some net short-term capital gains and losses, it's $1,656. So those items can be reported on Schedule D. So if we look at Schedule D, capital gains and losses, there is a line item for pass-through income. So we have line 5, net short-term gain or loss from partnerships, S corps, estates, and trusts from Schedule K-1. So there's our short-term capital gain of $1,656. If the fund had any long-term gains passing through, that would be reported down here in Part 2 on line 12. In our case, the K-1 only shows that we have some short-term capital gains, so we've only had to report short-term capital gains on Schedule D. Okay, now moving on to line 11, line 11C. So line 11, other income or loss, there's a lot of different items that can go into line 11. In this case, we've just got line 11C for Section 1256 contracts. So Section 1256 gains or losses are reported on a 6781. So on John's return here, if we jump down to the 6781, we have gains and losses from 1256 contracts. And so in Part 1, we report the EIN, the name of the entity where it's passing through from, so not real partnership. And we've got the loss of $782 reported there, right? So 782 in losses reported on the 6781. Now, once the 6781 is completed, the net gains and losses are split between short and long term. So we've got short-term capital gains or losses is 40% of the total. Long-term is 60% of the total. And so these amounts, after you've calculated them, are then also reported on Schedule D. So if you have Schedule D, go back here, you can see on line 4, we have short-term gains from 6781, right? So 6781, we've got $313 in losses. And then we have on line 11, the long-term component. So gains long-term gain or losses from either of these forms. So we've got a 6781 long-term capital loss of $469. Okay, so we've got the line 11 item in there. Now we're on to box 13, other deductions. So box 13 also has a variety of different items that can go in there. The first one we see, box 13 code A, are charitable contributions. So the fund donated to public charity, and it was a cash donation. So box 13 code A means there's a 60% AGI limitation. So you can deduct this amount as an itemized deduction up to 60% of your AGI. And so what we've done is we've reported that amount on Schedule A for John as an itemized deduction. So gifts to charity reported down here. So gifts by cash or check. So $81 is the total, and that's because we have another charitable item. If we go to the statement, line 13, other deductions, so these are all the items that are in line 13. So we can see here there's also a code 13B, cash 30%. So what's a cash 30% deduction? Well, when you make a donation to a public charity, so a 501c3 organization, you get that 60% AGI limitation. If you make a donation to a private foundation, it's lower, right? It's a 30% of AGI limit. So John's flow-through charitable contributions are the $23 plus the $58, but they're being separately stated, so we let the taxpayer know, okay, well, it's all charitable contributions, but each one has a different limit if that would apply to you. In this case, John's AGI is relatively high, right? So his AGI is, let's have a look. So his AGI is $181,000, so he's well within the range of not having to worry about any kind of phase outs for the 30% or 60% AGI limit. So that's why we just reported the combined amount, $81 here. He's going to get a full deduction for those charitable contributions. All right, and then the other items in box 13, we've got investment interest expense of $56. So 13 code H, investment interest expense. If we have a look at the 1040, that would first be reported on the 4952. So we've got 4952 here, investment interest expense deduction. We've got the investment interest expense reported up here on line 1. And so that's going to be the total amount allowed per Part 3 because we have enough net investment income. Remember, your investment interest expense and other investment expenses can't exceed your net investment income. But he's got $1,821 of net investment income, so he's got enough enough to be able to claim this as a full deduction. So on Schedule A, investment interest expense is reported in interest, line 9. So investment interest expense, we have attached to 49.52, and there's our $56 that's being added to his mortgage interest deduction. All right, now these other items, we have investment fees and accounting fees. So that's 13 code ZZ. And there is a note here to go have a look at the footnote. So if we scroll down here to find the footnote on those items. So here we go. So line 13 code ZZ, other deductions. The investment management and accounting expenses are miscellaneous itemized deductions under the TCJA of 2017. The deduction for 2% miscellaneous itemized deductions is not allowed, right, in tax years beginning after 2017 and before 2026. So normally, well, prior to the Tax Cuts and Jobs Act, 2% miscellaneous deductions, so things like investment management fees, those could get reported down here on line 16. So they were deductible to the extent they exceeded 2% of your AGI. But after the Tax Cuts and Jobs Act was passed, they repealed those. So these are still expenses that are incurred by the partnership, right? The partnership pays for investment management fees, they pay for accounting fees, but because this is an investment entity, those deductions generally aren't going to be deductible by an individual taxpayer. But the information is still provided by the partnership. It's just up to the individual to determine whether or not those can be deducted. In our case, we're not going to deduct these. We know they're 2% miscellaneous deductions, and so we're not going to report them on our Schedule A. Okay, now let's have a look at, okay, so we've done box 13. So we've covered all the box 13. Now we've got box 17 and 18. Let's start with 18 first. So 18A is tax-exempt interest. So the fund was invested in some municipal bonds. So if we look at line 18A and the other information, we have federally tax-exempt interest income of $310. And so that is municipal bond interest, which cannot be taxable by the states. It can't be taxable by the federal government. So where does that get reported? Well, the $310 of tax-exempt interest is reported page 1, line 2A. So we have the $310 figure, and so it's not being included in taxable income. Now, the tax-exempt interest, depending on where it comes from, it could be taxable depending on your state or residence. So we have another footnote down here, line 18A. They're letting us know that all of the tax-exempt interest income is derived from Florida municipal bonds. So John's a Florida resident. This is a moot issue for him because he doesn't pay any state income taxes. But if you are a resident of, let's say, New York, it won't tax New York municipal bond interest if you live there as a resident, but they do have the authority to tax out-of-state interest. So if John was a resident of New York, this would be tax exempt for the federal level, but because it's from Florida, he would likely have to include it in his New York taxable income and pay New York state income taxes on it. All right, so that's why we need more information other than just knowing, okay, it's municipal bond interest, it's exempt from federal income taxes because there is the state component. Now, line 17F, we have an AMT item. So if we go look at the details there, we have line 17, AMT, and we see here, code F, we have private activity bond interest. So the private activity bond interest is a part of tax-exempt interest. So if you have municipals that are engaged in private activities and a component is private activity bond interest, it's still exempt from federal income taxes, but you're going to have an AMT adjustment. So we have the total tax-exempt interest is $310, and the K-1 is telling us that $60 of that $310 is private activity bond interest. So all of it is still exempt from federal taxes, but we need to complete the 6251 AMT schedule, and we have an adjustment here on line 2G for interest from specified private activity bonds. So there's our $60 adjustment. Now, John isn't in AMT, so it's not as if he has to calculate any kind of AMT. Well, he did the calculation, but he doesn't owe any AMT. He just owes the federal. But if you're in a position where you are a taxpayer and you're in AMT, these adjustments are necessary, right? So you need to know if there are any kind of AMT adjustments based on what's flowing through to you from your K-1s. Okay, so we've done 17, we've done 18, line 19A for distributions. So distributions are also reported down here in the item L reconciliation, but these aren't really reported on the return anywhere. There's no schedule on the return itself where you would report distributions because the distributions is generally non-taxable, right? If you have a distribution in excess of basis, that's a different story, but we use this information to track our basis, but it's not a taxable item reported on the return. All right, so if we have a look in line 20, so line 20, other information, where are those? Okay, so the current year income or loss rec, so 3219, that's what's being reported up here in item L. This reconciliation just shows us how all these amounts came together in arriving at that current year net income or loss. So all the ordinary business income, the interest, the different cash contributions that are deductions, the 1256 contracts, and so on. All right, so now if we go on down, we've covered that footnote. Let's have a look at the QBI information. So qualified business income or loss, this is reported on the form 8995. So the QBI amounts aren't generated from the partnership directly. It's an investment. It's another entity that was invested in. So our investment is Not Real Partnership LLC. And then this entity invested in this business, Not Real Business LLC. And that's what's generating the line 1 loss of $8 for John. And so we can also report this amount on our 8995 on the 1040. So if we go back to the 1040 here, we have a look at our form 8995. So qualified business income deduction. The simplified computation here is what we're eligible for because our income is below that threshold. So we've got the K-1 from Not Real Business LLC. We report the EIN and then the amount of qualified business income or loss. Now, because we're in a loss position, there's nothing to be used in this year, but we'll have a carry forward. So on line 16, we have our qualified business loss carry forward. That'll roll forward to next year, and perhaps we can maybe use it next year. Okay, so that's the QBI amount. Now let's have a look at the basis worksheet. This isn't going to be reported on the return either, right? This is a basis worksheet that the partnership prepares for us that shows the reconciliation. But as it notes up here, very important, right? The outside basis is determined and calculated at the partner level. So you as the taxpayer, when you have to calculate your own basis outside of what the partnership computation would do. So the partnership might provide something like this to you, but it's not necessarily going to be the same calculation that you would use for your tax return. So the basis worksheet, we can see we've got increases for the amount of cash contributed during the year, increases for positive amounts of income, so the interests, dividends, capital gains, and then we see the deductions for things like the losses, charitable contributions, and so on. So John's ending basis here per the partnerships worksheet is $117,069, and so that reconciles with his capital account reconciliation here, right? His ending capital account for tax purposes is $117,069. Okay, so that's that worksheet. Then the last item here is the Schedule K3 notification. So the K3 notification, if you have a look at your 1065 Schedule K1, line 16, if this is checked, then it means they're including a Schedule K3. Schedule K3 provides more information on U.S. versus foreign source income, foreign taxes that might have been paid. In this example, the entity doesn't have any non-U.S. source income, no foreign taxes were paid, and all of the partners were domestic partners and no flow-through entities, right? So the partnership, if it meets these criteria, it is exempt from filing the Schedule K3 and exempt from filing the Schedule K2 with the tax return. So criteria 1, partnership had no or limited foreign activity. And then in criteria 2, each of the partners is a U.S. citizen, resident alien, or domestic trust. So if you meet all of these requirements at the partnership level, then they don't have to do the K2 and K3. But as it's noted down here, right, if you want the K3, you can request that the partnership provide one, but it has to be done in a timely manner. In our case, we're not going to need it, so we're not going to ask for it. Okay, so that's all of those items. Let me make sure I haven't missed anything here. So we've covered Schedule B, we've covered Schedule D, Schedule A, the itemized deductions we've looked at. Yeah, so everything seems to be reported on there. So I hope that was helpful. Just a quick walkthrough of these 1065 K1s. Not every item is obviously covered, right? I mean, if you had rental income in there, maybe some tax credits would change the fact pattern a little bit, but this does kind of cover a lot of the items that we would normally see, particularly with these kind of investment entities. So, thanks for watching. I hope that was helpful, and I look forward to seeing you again on the next video. Thanks.